King, 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 king.
Great Tuesday, everyone. Welcome to the King Connections podcast. I'm your host, King, and I'm excited to today's show. We're going to talk about real estate. More importantly, we're going to talk about the importance of real estate investing and how you can be an investor in real estate. So, without any further ado, I have a guest joining me who's been in real estate for years, expert in doing real estate, particularly with doing commercial real estate projects. And I'm happy to bring to the King Connection show Aaron Fragnito. How you doing today, Aaron?
Hey, King, I love that introduction, man. That's amazing. Great work there.
Thank you. Thank you. So I always like to begin every show with this question just to kind of set the context for the show. And the question is, um, on a scale from 0 to 10, where 0 being life sucks to 10 being life is awesome, what would you say your spiritual engine number is right now?
My spiritual number?
Yeah, spiritual energy number, like
Spiritual energy.
0 being
Okay.
life sucks, 10 being life is awesome. Where would you say you
You
are
know,
right now?
Pretty good, man. I was coming to work today, and blasting that Christian rock. I was praising in the car. I had my hands up, really feeling the spirit, man. Just thankful for everything the Lord gives us. And my alarm went off like an hour late this morning, so I missed my 6:30 a.m. workout class, which is a brutally hard workout class. And instead, I read some scripture, and just had a nice morning, praising Jesus Christ, man. Just being trying to be a good disciple here, and so had a nice morning, really getting in touch with God. And then here I am at work, focused, man, ready to rock, so it's a nice way to start your day. Yeah.
Excellent. Well, glad to have you here. One of the things that I always like to begin every show with, and the reason I asked that question is, and I was looking for a number. Would you say you
Oh, a
are?
number. Okay, I'm gonna give it a 9 because I think I'm still a sinner, man. I'm still a sinner, so we're not a 10. We're never gonna be a 10, but I'll give it a 9. All right.
Excellent. The reason I asked that question, and thank you for answering, is because I asked the question because it really sets the tone of the show. If someone's a 1 or a 2, and they're not really going to be a good guest, not going to be engaged, they really won't go well. So when people are 7 or better, then we're going to have an excellent show. So that's what
Okay.
that's my purpose for asking. I'm a 10, and the reason I say I'm a 10, I get what you're saying. We're not perfect. It's not about really being perfect. It's about really choosing, because it's a choice. And I choose to be a 10 mainly because there's no value in choosing anything less than 10 from my perspective. And then more importantly, like you, I go through what I consider my gratitude moments every day when I wake up in the morning, things I'm grateful for. And once I go through that, my ability to see, hear, walk, talk, stand, breathe, have sound mind, another 24 hours to be alive, a mother who's still alive, so those things, that puts me at a 10, regardless of whatever is going to come my way that day. I'm protected. I'm set.
Yeah. Amen. Yeah.
Then I challenge myself that if I'm not a 10, I do something before the end of the day to make sure I'm a 10. I never take a negative day into. I have negative moments throughout my day, but never a negative day. So it's kind of my way of getting the show started. So thanks for walking through and sharing that with me as well.
Sure. Yeah. Gratitude's everything, King. I like to do some gratitude journaling in the morning. I don't do it every morning. I could be better about it, but I really puts you in the right mind space, and it's gratitude is everything in this world.
Absolutely. And it always is a great way to, like I said, to get the show started. Our listeners to watch the show, and it gets them thinking the same way as well. And like I said, it just really sets everybody's energy and endorphins. So whether they're watching the show live or whether they watch the show as a replay, it just really sets a good energy level for the show. So, so now,
Absolutely.
with that being said, let's talk a little bit about your background a little bit before we really get to the meat of the show.
Yeah.
I'm curious to start with what got you into real estate?
Well, my friend, I read Rich Dad Poor Dad. It was senior year of college. I was graduating from Rowan University with an entrepreneurial degree in 2009. And the U.S. economy was in complete free fall. We would have like job fairs at the college, and there'd be like a lot of empty tables there because no jobs would show up because no one was hiring. So I was like, what the heck am I going to do with my life here? I'm an entrepreneur major. It's kind of an open-ended major. Is it a good time to start a business? Is it not? I need to learn an industry. I need to figure out what I'm going to do with my life. And, of course, I was a broke college kid, so I didn't have much capital to start with. But I was able to basically read that book, Rich Dad Poor Dad, understands how wealth is protected, how it's preserved, how it's created, and why the rich get richer and the rest of us work so hard to accomplish that. And how to pay yourself with the bank's money through refinancing, cash flowing assets, and so on. And then I was like, okay, I think I want to be a real estate investor. And I actually ended up moving out to Steamboat Springs, Colorado, and I taught kids how to ski for 6 months, and lived with some buddies out there. I had a great time. I love to ski, and read all these different books on real estate investing. David Lindahl, Trump University, and they all say, "Oh, it's easy. You just you raise a little money, you buy a big $100 million commercial piece of real estate. You put up a 1% deposit, and bada bing, bada boom, you got yourself some real estate. You improve the value over time. You refinance." So I said, "Oh, that sounds easy enough." So I made a list. I said, okay, in 10 years, I want to have $1 million net worth and $100,000 of passive income. That was at the top of my goal list. And then I worked my way back down from that. I got to learn the industry. I got to make connections. I got to make money, figure out, build relationships with investors. And I said, okay, I'm going to start as a realtor. So I moved back to Jersey and I got my real estate license, started selling houses, dismal market, 2010. You'd list a home, no one would call. Just sit on the market. No one was buying houses. So I learned short sales. I learned REOs, bank-owned properties, foreclosures. I would staple signs to telephone poles that say, "We buy houses," which used to really work because no one was buying houses. So I would get a lot of calls. And then I'd either wholesale those deals, meaning I put them under contract and then flip the contract or sign the contract for a fee. Or sometimes if they opted to go the realtor route, I would list it as a realtor and make a commission. And I would learn short sales. At that time, there's a lot of short sales, meaning you owe more to the bank than your property is worth. So I teamed up with a short sale negotiating company. Actually, the guy who owns that company is one of my investors to today and one of my close friends. So they would negotiate these liens with the bank. And I remember at the time, realtors didn't know how to do short sales. They were like a mystery. What realtors would do would list them at what they owe to the bank. And so it'd be listed sky high and no one would call, and they'd sit on the market and expire. So I'd call all these expired short sales. I'd say, listen, your last realtor did it wrong. We're going to list the property at market value or even a few specs below market value, like 10% below market value. And we're going to get a lot of offers on the table. And we're going to go with the best buyer. And then we're going to submit that offer to the bank. We're going to use the short sale negotiating company. We're going to negotiate your lien lower, and at the end of the day, we'll get your debt erased. We'll get you move out costs, move out funds. The bank was paying people up to 20 grand to move out of their home.
Wow.
We'll get this debt off your books and you can move on and rent for 2 years and then own a home again 2 years later once that foreclosure is kind of cleared through your credit a little bit. So anyway, at the end of the day, it was a win-win for everyone. The buyer would then, I would also, through this process, meet a lot of investors that love to buy these short sale properties, which often need a little work. They'd be like fixer-uppers. And often the best buyers were cash offers, no inspection contingencies, so I get to know those buyers, know those investors, see how they're working. And then I'd be able to represent the buyer and the seller, earn a larger commission. I was able to save up money that way and start investing in real estate. And so, through that process, I learned the market. I learned North Jersey real estate. I made some money as well. I was able to start buying income properties and found some good multifamily deals through that same method of we buy houses signs on telephone poles, which worked at the time. Doesn't work these days because you don't need to put a sign on a telephone pole to sell a house in North Jersey. It flies off the market. So anyway, at the end of the day, that's I broke into the space. I met my business partner, Seth Martinez, speaking at a real estate networking event. and also met investors that way as well. Started raising capital. Seth and I teamed up in 2013, buying a 6-family together in Newark, New Jersey for $220,000. We put about $80,000 into it, refinanced all our money back out in about a year after we got the building leased up. And then, light bulb went off. Said, hey, we can recycle our cash and keep buying real estate by the buy, renovate, rent, refinance strategy. And we did that. We built a nice portfolio over the years, about $40 million or so, and about 200 doors throughout North Jersey here. In 2015, we developed a management company, PCG Property Management, to start managing our assets as well. And we also do fix and flips. We have a debt fund that investors invest in and earn an interest payment. And we've done about 60 fix and flips. We've done about 100 wholesale transactions. I've done about 300 transactions over the years here in Jersey. And now we buy bigger assets. We're working on acquiring a $36 million asset right now. We just closed on an $8 million asset that our team is now working on repositioning. So we're, bigger is better in real estate. So we're buying bigger properties these days.
Excellent. Excellent. When you shared your short sale story, I relate to that. I also was doing short sales around 2010. So not as a realtor, but more as an investor, walking around, going around. I actually call myself, I like to save my home. This is prior to obviously the housing market crash when they changed all the housing rules. But I was able to go down on people's doors and help them avoid foreclosure by doing a short sale. And I used to be the person that would actually call the bank and negotiate the actual short sale terms with the actual bank. So definitely relate to your origin story. I'm curious to know, how difficult was it for you to transition from residential real estate to commercial real estate?
It was, I think the hardest part was transitioning from a realtor selling residential properties to an individual raising capital. Those are very different things.
Right.
You could argue they're both sales and they share a lot of aspects, but they're actually quite different. When you're selling someone a home, for an investor, I spoke investor language. I still do. I understand, investment metrics and, repair costs and things like that. So I connected better with investors. It would annoy me a little bit when I'd show someone a house for a great price and then they'd be like, I don't like the color of the dining room. We're like, yeah, but the home's like $40,000 below market. You could hire 6 or 7 painters. And, but they're like, yeah, but I want a red dining room. I'm like, no, you could change the dining. Look at the price. Look at the value. That was annoying. I don't think I had the patience for being a residential realtor, and selling to, move-in owner occupants. Oh, but that is a great value. I think there's a definite need for that in our market. I mean, buying a home is a very complicated process, and I saw a lot of people were unfamiliar with it. And so, that's a definite great service out there. I don't think I quite had the patience for it, although I did sell a lot of houses that way. I really connect with the investors better. I still do today. But when you're selling a house or selling anything, selling an investment property, it's a numbers thing. Hey, here's the deal. Here's the target returns you're going to get from it. Here's the market value. Here's the price you're getting it for. Look at that. Here's the repair estimate, and it pretty much sells itself if it's priced right. And you could put the story out there the right way. Raising capital is completely different. People invest in the person. They invest in you. The deal is secondary. Now, the deal's got to make sense. It's got to achieve their investment goals. It has to be, a good deal that targets roughly what they're trying to achieve on their return on investment. However, that's really secondary. What's primary is how much they like you, how much they trust you, the feeling they get when they talk to you. Right? Do you seem like a sleazy salesman, or do you seem like an honest dealer? That's someone that's going to bring them value and work with integrity. And so that's a relationship, and relationships take time. You could meet someone, at 3:00 and sell them a house by 4:00, right? it's not, if it's a good deal. Now, for move-in owner occupants, there is a relationship process, sure, but the truth is it's a transaction, right? Investing is a relationship, right? So I had to learn that over the years and convert out of the mindset of being a salesman and into the mindset of being a thought leader and a relationship builder. And that allowed me to truly start to raise capital on a larger scale, especially with more savvy individuals as well. When you're working with people that are investing potentially millions of dollars, you really have to be sharp. You got to be on your game. You got to know your stuff. And so as I've worked, my first investment I ever solicited was probably $30,000, right? And now we work with family offices that invest north of $1 million. So you have to know how to talk that language as well. And that's been a process, kind of working my way up the ranks, if you will, of capital raising.
Well, now I'm glad you mentioned several times the importance of relationships.
Mm-hmm.
And that's really what my specialty in my area of focus is with King Connections. And you see, I have my formula, what I call connecting with intent: strategy plus connections plus systems plus value equals capital. Social first, then social generates financial capital. And you just kind of alluded to that as well. What would you say is some of the key challenges you face with raising capital for your projects?
Well, right now, it does seem like a lot of people are just a little tight. Inflation has done a number on us. I think market optimism has definitely suffered over the last few years as inflation kind of flourished. So people are just a little tight on cash right now. So you really another reason why we do try to focus. We work with a lot of accredited investors, which is great. They've helped us get to where we are right now. We have about 100 of them. Accredited investors are generally investing anywhere from $50,000 to maybe $300,000. We had about 15 accredited investors or so on our last opportunity. I've had up to over 40 before on one deal. So, however, as we enter now the space of family offices, you realize, there's different levels of wealth, and the ultra wealthy are less affected by prices increasing, where just your more standard high net worth individual is more affected by it. Here in North Jersey, if you make $250,000 a year, I know it sounds crazy, but if you have like 3 kids, you make $250,000 a year, you want to live in like Short Hills, New Jersey, you're like getting by. That's like just squeaking by, and it's crazy. I mean, $250,000. I remember when I was like in school, that was like, you made it, man. You're
Absolutely.
at honcho. But in North Jersey, just to get a home in a lot of these, not even a big home, like a decent home, like a 3 or 4 bed, 2 bath is like $850,000 to $1,050,000
Wow.
in a lot of these towns. Oh yeah, man, it's crazy. So there's $6,000 a month on your mortgage payment. So you'll do the math. It adds up. By the time you have your car payments, your house payments, and then it's hard. It's hard to get by here. So people are a little stretched, I feel. Even high earners, right? So now there's more affordable places to live in New Jersey, of course, but for some of the more affluent areas, that's what it costs. So I do see that challenge right now. However, I think a lot of people are a little tired of the volatility of the stock market. It's had a good run. People have done well. The mutual funds, their stock portfolios have done well in the last 2 years, mainly because of inflation and high government spending. And we've seen, good growth there in the stock market. A lot of more experienced investors are saying now they feel the stock market has tapped out a little bit. Alternative investments are more desirable. Real estate would be an alternative investment, oil and gas, things like that. So people are looking into alternative investments more and more. passive investing in real estate syndications has become more of a mainstream thing. Where back when I got started in 2013, it was pretty much me and Joe Fairless trying to raise capital. Joe Fairless grew a lot faster than I did. But basically, that's where we're at. So, there's some pros and cons, but it's all about your relationships. I raised more money last year than I have in any of my years of fundraising, and arguably one of the hardest equity spaces. But one more note on that, as we talk to institutional level capital, okay, institutional level capital are generally multi-billion-dollar funds. Okay, for example, we spoke with Travelers Insurance, a $9 billion equity fund. They allocated in 2024 the same amount of capital that they allocated in 2010, 2011. So, they during the Great Recession, right? So that gives you an idea of how tightly even institutional capital is holding on to its cash right now. People are conservative, and that's the smartest capital out there, institutional capital, right? So if they're holding on to it tightly, then I understand why accredited investors are as well.
Yeah, thank you for sharing. I know that today you're gonna walk through one of the presentations you do to show investors, and that's going to be a treat for my listening audience and investors who actually might be interested in actually becoming investors for you, accredited, of course. But before we get into the presentation, what I want to ask you a couple more quick questions. Number one, what do you see as one of the benefits of, now I'm asking this more from your personal perspective, one of the benefits of buying into multi-family buildings as opposed to just maybe a commercial like REITs where you might buy into a parking lot or structures like that? Just curious to see what your thoughts are on that.
Sure. So when you say REITs, that's kind of a vague word. You have publicly traded REITs, which are stocks backed by real estate. The thing about a publicly traded REIT is it could be a great investment. You probably want to have some in your portfolio, but publicly traded REITs are stocks. They go up and down very quickly. The beautiful part of a publicly traded REIT is it's very liquid. You can buy it and sell it in the same day. It's extremely liquid, right? It's a stock. The negative part of a publicly traded REIT is that it's extremely liquid. That means that it's going to go up and down very quickly. It's very volatile. Okay. So the benefit of investing in, perhaps a private REIT, which owns actual real estate, or just a real estate syndication, direct investment, which means you're investing in one building. Okay. There's pros and cons of both there. But when you're investing in actual real estate, first of all, you get tax depreciation, right? You're the owner of actual real estate. When you own a publicly traded REIT, you own a stock. So aside from the volatility of it, you're also not getting tax depreciation. All right. However, publicly traded REITs can have decent dividends, sometimes 6 to 8, 9%, depending on the REIT. Now, a private REIT that owns, direct investments into real estate, or a real estate syndication, whether it's a direct investment into one building or multiple buildings, a fund that owns multiple buildings, you're getting ideally tax depreciation. When we buy a property, we do a cost segregation study. We accelerate our bonus depreciation. That means investors get about a 25% tax write-off the year we buy the building. If they invest, we buy the building in the same calendar year, then they get that big tax write-off as soon as we buy the building, right? So we accelerate that tax depreciation. That's huge. So that's one benefit. Secondly, there is very little volatility, right? When you're investing in a direct investment. We just bought a 42-unit apartment building in Passaic, New Jersey for $7.6 million. We have a value add strategy. We have our contractors there and our team doing the renovations, repositioning the asset, building the revenue, making the property more desirable to live there. And we have an exact plan for that building. We have a timeline, a 5-year timeline. We're going to buy it, renovate it, build the revenue, make it a better place to live, refinance at month 37, ideally get back about 80% of investors' capital at that time, and then sell it at the end of year 5. Yes, there is some variables there. We want to keep an eye on interest rates. We want to keep an eye on market dynamics. But for the most part, we're not at the mercy of the stock market. It is an illiquid investment. You're invested for those 5 years, right? So you want to be aware of that as well. If you have capital that you might need back if your car breaks, then don't invest in an illiquid investment like a direct investment, like a real estate syndication, because your money is locked in for a longer period of time. However, a good real estate operator and a good real estate syndicator, a good deal, can procure returns around 20% IRR, internal rate of return. We are targeting a 19% IRR on our current offering. That's pretty good. It's pretty strong, pretty aggressive. Most mutual funds are going to target somewhere more around the 8 to 10 mark or so, right? So it depends on what the market does. There's no controlling it, right? Your mutual fund, you're in for the ride. So you want to have a combination of liquid investments like publicly traded REITs and equities in the stock market, and illiquid investments too that have less volatility, tax benefits, and high targeted returns. The bottom line is you want to diversify, right, with any investment strategy. So I do think people are seeing syndication now as a more viable option to park some of their hard-earned money and protect it through tax strategy and tax benefits, and also grow it faster too.
Absolutely. And my last question, and I want to give you an opportunity to walk us through actual deal you're actually working on. What criteria do you look for in choosing to invest in a particular real estate project?
So we look for value add. We want to be able to increase revenue on the building. Usually that means by renovating units and leasing them up for fair market value. Generally rents are 20-30% below market value. We also look for making your money when you buy, a discounted purchase price. We look for location, right? Location. It's important to be in a desirable location for the price to be right for the location. We look at rental comps, the demand for the rental market. We look at new buildings coming online, competition, how much market saturation you have in that market. The age of the building is important. We're not afraid of buildings built in the 1930s. That just has to be factored into the costs and the CapEx budget. But we're actually a little, we have a pretty wide spectrum when we do focus on multifamily, but the last building we bought was a Class C building with a ton of value add opportunity, built in 1940, that we're going to reposition into a Class B building. Next building we're buying is a Class A building, brand new construction. Rents are below market value, but by a smaller amount. And the developer, the builder, is just motivated. A lot of these developers, they've been working on these things for 6 years. They finally got it built and leased up. Now they have this beautiful brand new building, and they're ready to cash out. They're ready to take their payment and go. But oops, the market is soft. Cap rates are high. Prices are down. So they're not able to quite sell for what they thought they would, but their loan is coming due. Their interest rate is increased. They didn't estimate rates being so high, so they're motivated to sell. And we are finding opportunities in that space. Brand new Class A real estate, slightly underleased, some value add, but not a whole lot to do to it. It's not as heavy a lift as a lot of the buildings we buy. They're just mismanaged, trash everywhere. These are beautiful Class A buildings, brand new. You don't have to worry about replacing the boilers and things like that as we normally do on older properties. That we see opportunity in both spaces. Vintage real estate that's mismanaged, underleased with lots of value add. And then on the other end of the spectrum, we see Class A real estate, brand new development, motivated developers who are kind of stuck being landlords. The high interest rates and the high cap rates have put them in a tight spot where we're able to come in and buy the property for a decent price and increase the rents better, manage it a little better, and then really exit the asset over the next 3 to 5 years, ideally in a bit of a better market. If rates do tick down, that correlates very closely with these Class A values. And so we're buying properties right now that, we're buying a beautiful high-end luxury Class A plus asset, brand new development on the water, looking over the water into New York City, just an incredible building that used to be going for 4 caps. We're buying that for like a 5 cap right now. And it doesn't sound like that big a difference, but when you're talking about, 30 million plus assets, that's a big difference. That 100 basis points in the cap rate is a big difference. So that's where we're seeing value at as well.
Thank you. Well, let's get into your presentation. So let me share the screen here.
Mhm.
See if we can actually make this a little bigger. So if you wouldn't mind walking us through what we're looking at in terms of this
Sure.
particular deal.
All right, buddy. So here we go, King. This is a 42 unit apartment building in Passaic, New Jersey that we purchased in December of 2024. And this is an opportunity here to get into a Class C building that we're repositioning into a Class B with plenty of value add opportunity. I'll go through it pretty quickly here. All right. Okay, so a quick disclaimer, this is a Reg D 506C for accredited investors only. An accredited investor is someone with a net worth of $1 million, not including their primary residence, or an income of $200,000 individually, or $300,000 including their spouse, with the expectation to make that next year. If you're not an accredited investor, we do have a Reg D 506B, that's our debt fund, but this presentation is not about that. That's about this 506C opportunity right now. So this building here, we bought it mostly fully occupied. We now have one vacant unit that we're renovating. This is a $4.1 million raise. We have about 87% of it raised. This is the last final bit of the CapEx, the renovation funds we're finishing off now. We have, depending on the share class, net LP IRR of 20.3, a net LP multiple on capital about 2x, an investment period of 5 years. We plan on selling the asset over a 5-year period and refinancing in month 37 for a big liquidity event, and we're already distributing cash flow on this asset. For those of real estate whizzes out there, there's an unlevered going in yield of 5%, stabilized cash on cash at 7%. So once we lease up the building for fair market rent, renovate the units, create the amenities we're looking to place into the building, that should be then a stabilized asset at that point. Create a cash on cash at that point around 7%, and our restabilized yield on cost around 8%. We're buying this we bought this for $7.6 million, about $182,000 per unit. We expect an appraisal value of about $12.3 million after 3 years of repositioning the asset, returning about 80% of investors' capital at that point. Our project level gross equity multiple is 2.13x. Our gross average annualized return, AAR, is 16.3, and our gross levered IRR is 21.8. It's 42 units in total. So we've been around about 11 years here at People's Capital Group, a little bit over that. We've been, Seth Martinez and I, my business partner. Seth handles mainly the operations of the business. I'm more on the client relations. We've been just focused on North Jersey here for over the last decade. We are vertically integrated with an in-house property management company, so we manage all of our assets in-house. That way we keep our efficiencies tight and our projects on budget and on schedule. We have great relationships with contractors and service providers to keep our costs low on that front. And we get great off-market deals. It's all about knowing brokers and wholesalers, and property managers and landlords, and buying properties for discounted prices. See, when we bought this property, we were the only bidder on the table, only buyer on bidding on this property. And that's extremely important. And that allows us to get these properties at discounted prices because we move quickly and brokers or wholesalers bring us them directly without advertising them to other buyers. So that's how we're able to acquire these at discounted prices and then bring them to our investor base as a good investment opportunity.
A couple quick questions for you.
Mm-hmm.
When it comes to this deal, from a liquidity and investor cash flow perspective, what would you say is the timing of cash distributions?
We do our distributions on a quarterly basis. Yeah, the next slides will get into that. Yeah.
Okay. All right.
Yeah. So vertically integrated, as we were saying, local market expertise. We focus on Class B and C real estate and Class A as well. We look for risk-adjusted properties with lots of value add.
Excuse me, Aaron. I'm sorry, but your slide's not progressing. We're still on the slide 1, actually.
Oh. Let's see here.
There we are. Now we're on slide 6.
Okay. I don't know why it did that. Do you see me changing the slides now?
No.
Okay. I'm not sure what. Okay. I'll just have to do it this way. All right. So essentially, yeah, I don't know why it's here. Let me actually try to do this real quick. Hold on. Let me do this. I'm just going to share my entire screen. Okay. All right. Now, how's that look?
Yeah, they're transitioning well now.
Okay, very good. So just a couple exits and acquisitions here. Here's a 21 unit we purchased for $3.9 million in Bayonne, New Jersey. We are on schedule and on budget there with that one. We'll be hopefully refinancing that over the next year or two. Here's an 11 unit in Patterson, New Jersey, not too far from this target property that we refinanced successfully, returning about 50% of investors' capital over a 2-year period to our investors on that. Here's another building in Passaic, New Jersey that we recently sold and achieved a 11.1% cash and cash return to our annualized cash and cash return to our investors, which was our target on that building. Overall, we've about a 14% annualized internal rate of return. We've completed 300 transactions over the last decade or plus here in New Jersey, Seth Martinez and I, and we have about an 81% investor retention rate after a liquidity event. About 8 out of 10 investors reinvest after a liquidity event. So Seth and I, we both started in real estate around the same time. He had sold a medical billing company. He was very liquid with cash. I was good at sourcing deals. So Seth handles the operations. He manages the management company. I'm more in charge of client relations. I'm sending out monthly updates, quarterly financials. Our 3 goals for our private investors is preservation of capital, return of capital, and return on investment. We've actually done 10 syndications over the last decade here throughout New Jersey. Here's the property location there in Passaic. It's not far from the George Washington Bridge, Manhattan, Hoboken, Caucus. It's less than 10 miles to New York City, and that's what we focus on, buying assets that allow for less than an hour commute to Manhattan. There are 11 bus stops within 5 blocks of this property. There's one train station less than a mile away, Passaic Station, and Garfield Station is about 1.3 miles away from this one. There's Seton Hall not too far away either. Montclair State University as well. We have a $1.1 million CapEx budget to renovate this asset. It was actually built around 1950. It's a 4-floor building on the left there, a 3-story building on the right, 2 buildings right next to each other there, 42 units in total, 13 one-beds, 28 2-beds. We actually found out the studio is not a studio, it's a 1-bed. So sometimes you come across a nice surprise when you actually buy a building. So not always the case, but so it's actually about 14 1-beds and 28 2-beds. The average rent of the building is about $13.99 a month. We believe we can increase that revenue price per unit up to about $19.35 per unit. That's about a 38% increase in the rent roll on the building here. With our CapEx budget, we plan on doing a lot in the basement. We'll put in laundry and storage. We'll put in most of the money is going into the interior units are being rehabbed. We'll be renovating units as tenants move out and working with our existing tenant base as well to renegotiate leases. We'll put laundry in the basement, which creates another revenue stream, and storage units in the basement as well. Again, additional revenue streams into the property. And in the backyard, we plan on doing a dog walking area and a barbecue area and a nice little jungle gym for the kids. So just create a nicer place to live, a more desirable building, and really reposition this asset from a Class C into a Class B building. And that's our main target here. A quick note, the landlord previously was already renting a 2-bedroom for $2,100. We plan on leasing these around $2,150. So he's already leasing unrenovated 2 bedrooms in the building with trash in the basement, trash in the backyard, mismanaged asset, for 2,100. We're targeting 2,150. So we're pretty conservative. The rental market's very strong there. We'll probably be able to get more than that 2,150, but you always want to promise and over deliver.
Quick question for you. What's the current occupancy rate of the building now?
It's 95%. We have one vacant unit.
Okay.
Mm-hmm. So, the amenities here don't create a lot of revenue, but they allow us to create a more quality lifestyle for the tenants. The laundry and the storage will create small revenues for the building. The backyard renovations will not create any revenue, but it will create a nicer place to live with the dog run, children's playground, barbecue area. Right now, you can see it's just a bunch of carpets and trash and like chairs and stuff. It's not really being utilized. Here's the market overview. We're about a half mile from ShopRite. We are about 2 blocks to the elementary school. We're literally down the street from a private school. About 3 blocks to TD Bank and the main Ave. They're about 1.5 blocks to the main Ave where there's shopping and restaurants. The Passaic High School is about 5 blocks away. Passaic Academy is about 4 blocks away. So we're right in a nice walkable area there to restaurants and stores, schools as well. And there's a lot of bus stops there. The main bus terminal is about a block away from our building as well. Here's the Passaic history. We don't have to get into this too much, but essentially it's about 70,000 occupants live in the city of Passaic there. Now, Passaic's an interesting city. It's really experienced a revitalization. The tallest office building in the city sat vacant for 20 years. It's recently been leased up, and that really helps a city revitalize. So we are sitting just outside the in New Jersey redevelopment plan here for Passaic, where they plan on redoing the bus station there, the bus terminal, soon to be completed, pedestrian retail streetscapes. So when you're looking at investing in an area, look at the city master plan. That'll tell you a lot about the desirability of the building and the area and what's to come, right? Because we're not investing just for what's there right now. We want to see what's the area going to be like 5 years from now, 10 years from now, right? And then just understand those options 3 years from now. So understand the direction the city is going and making sure that we are in near that city plan of where the growth plans to happen. And you can see here we're literally right next to where a lot of this redevelopment is being planned. So here's the demographics of the area. 60% of households rent in Passaic. There's a 1.5% vacancy rate, which is extremely low, meaning there's just not enough housing. There's an insatiable demand for housing in North Jersey in general. New Jersey boasts a 3% vacancy rate, which is very, very low. I think it's like first or second in the country. There's not enough housing in New Jersey. It's often an overlooked market, but there is so much opportunity in New Jersey. There is not enough housing. There's an insatiable amount of demand here. People that need to live within an hour commute to Manhattan. There's great schools in Jersey, great neighborhoods. So, we talked about the location to the major retails there on Main Ave, 11 bus stops within 5 blocks, 2 New Jersey transit stations within 2 miles, and the big bus terminal down the street is getting a $15 million in federal funding renovation right now.
And you said the average family income was about $90,000 a year?
Average household income, is $90,000 per year in 2023. That's right, my friend. Yeah.
Okay.
Yep. Which is a higher income, considering the median household income in America is what, like 52,000 or something, right?
That's what I was thinking. Yeah.
Yeah. So it's you got to earn at least that to be getting by here in North Jersey. Yeah. So it's decent area. Low leverage, high cash flow. That's our goal. We're looking at about 2.6% cash flow year one. We're already distributing cash flow on this asset. We just had our first distribution at the end of January. Year two, we're targeting about a 4.8% cash flow distribution. Year three, as we stabilize the asset up to market rents, finish our renovations and repositioning, we'll be looking at about a 9.2% cash flow distribution to investors for year three. In total, we acquired a loan amount a little bit more than $5 million, but there's our closing costs, there's the soft costs. We can send this all to any serious investors that want to take a look at these numbers. We don't really have to dig into them all right now. So in the interest of time, we'll just kind of keep moving here. We have our expense growth at 2%. We have our rental growth assumption at 3%. So we don't want to assume the market rents grow at the rate they've been growing, which has been far more than 3%. But we have pretty conservative estimates there on long-term growth of rents and expenses. Here's our loan. We got a 5.4 interest rate actually on our loan. And we were able to do a 2-point buy down on that. So we locked in even a better interest rate than we're showing here, about a 5.4 interest rate. And that allowed us to really just get a great amount of leverage on this property. Here's some comps, rental comps for this building. We see most buildings renting for a little bit more than what we're targeting, but we want to be conservative here. We see lower vacancy rates than what we're targeting, which is a 5% vacancy rate. Most buildings all the buildings we see here are below that. So we're pretty conservative on our assumptions here, and that's the right way to underwrite any opportunity. Yield on cost, we plan to grow it over time, get it up to about 8.3% by the time we go to exit the asset. That's as we implement our repositioning strategy. We were more aggressive over the first 3 years as we renovate units and input those amenities throughout the building. Then years 4 and 5, after we refinance, the building's more stabilized. We'll just continue to renew leases. We assume about a 20% turnover, which is a little high, but hopefully we're below that. But you want to also, assume a high turnover. So it's safe to do. Here's our exit strategy. We assume a 6% cap rate upon sale. We assume the market is what it is today. We assume cap rates are high. We assume prices are low. By doing that, hopefully we have a better exit. But we also don't want to assume the market's any better than it is today. Hopefully rates are lower. Hopefully prices are higher. If that's not the case, then we'll be on target. We get assuming about $317,000 per unit on the exit, about $13.3 million exit of value. Our levered IRR to investors. Now we're out of Class B shares. Like our Class B shares are sold out. We do have a few more Class C shares available. That's an 18.9% target IRR. That's a 13.8 target AAR. An AAR is an average annualized return, and IRR is internal rate of return. The difference is an IRR takes into account more of the time your capital is at work, where an AAR is based more on a annualized basis. The levered multiple on investment is 1.9x, meaning on a $100,000 investment, you'd expect to walk away with about $190,000. Okay? So again, on a $100,000 investment, you expect to walk away about $190,000. That includes your refinance proceeds, cash flow proceeds, and sale proceeds.
And that's at the end of when you sell at the end of 5, was that 5 years?
Yeah, 5 years. Yeah. So cash flow is distributed quarterly. Okay, grows over time, starts low, around 2%, builds up over time to about 9%. By year 3, beginning of year 4, we go to refinance, where you expect about 80% of your capital back. And then we cash flow about 5-6% the next 2 years, and we go to sell into year 5. So there's 2 big liquidity events: beginning of year 4 refinance, into year 5 sale, and then there's cash flow along the way. It's distributed quarterly. All in all, you'd expect about a 1.9x equity multiple. So a $100,000 investment, you'd expect to walk away with about $190,000 over a 5-year period. Here's our sales comps. Okay. Again, these are mostly comps from 21 to 24. So ideally, no one knows when the market will be in 5 years, but we want to be conservative there. Here's just a little more information on, what we aim to achieve here. We've achieved about a 12% annualized cash and cash return. Average syndicates more around 8.5. So we really strive to achieve a better return on investment to our investors, and that's by finding great deals. We focused on multifamily mixed-use properties only within an hour commute to Manhattan here in the North Jersey market, with multiple exit opportunities along the way with the refinance and the sale. The main three things we focus on is preservation of capital, return of capital, and return on investment. Okay, the preservation of capital is accomplished through the tax depreciation, the building, and the cost segregation provided by the building. The return of capital is accomplished by the refinance, which we aim to achieve at month 37. The return on investment is achieved by the cash flow and the sale of the asset. So preservation of capital, return of capital, and return on investment are our three goals there. Again, as I was saying, about 300 transactions completed over the last decade. Our portfolio value is actually around $40 million right now. We have about 100 investors that invest with us. These are accredited investors, family offices, high net worth individuals, vertical integration with an in-house property management company, and a 10-year track record focused strictly on New Jersey. I don't have to get into this much right here. Why multifamily? You know, there's just an imbalance of supply and demand here in Jersey. There's a huge demand for housing. There's a huge demand to own real estate here. The exit is quite simple. There's a lot of companies that want to own real estate in North Jersey. Tax advantages, hard asset, backed by an actual hard asset. It's not a stock backed by real estate. It's investing in a real asset. It's a direct investment, cash flow as well, capital appreciation, favorable demographic trends, and market pricing here as well. So a few case studies. We talked about the property in Paterson, New Jersey. This is right around the corner. We achieved a 23% annualized cash-on-cash return through our refinance and 2 years into this deal. Here's a building in Passaic, New Jersey, the same city as the building we're buying. We achieved 11.7 annualized cash-on-cash return on this building. Our target was 11. Here's the 21 unit we own in Bayonne, New Jersey, the Riviera. This building, we're doing a lot of work to it, installing separate HVAC units, increasing the rent roll by 34%, renovate and lease 75% of the units of fair market value. We plan to complete a refinance on this and target about a 12% annualized cash-on-cash return to investors. By year 5, we'll aim to refinance hopefully sooner. 105 Marion Street. Here's another building. We're actually going to be selling this building. We were going to refinance it, but since rates are high right now, we're going to just sell this asset. We bought it in the end of 2020. We'll be selling it now towards the second half of this year. We'll expect to get about a 14% annualized cash-on-cash return to investors through the exit of this asset. Here's a building on Milton Ave in Rahway, New Jersey, near the train station. We're cash flowing nicely on this asset. We put about $346,000 into these two buildings, 27 units throughout two buildings here with a big parking lot. We're talking about a 12% annualized cash-on-cash in this building. We'll probably overperform on this building. Our cash flow is going very nice now. We plan to refinance this as rates come down. There's no big rush. We have a great rate locked in for another 2 years on this building. So there's me, Aaron Fregnino, on the left. There's Seth Martinez. Seth really operates our debt fund. He oversees the operations there. He sources properties for the debt fund. Investors can participate in that and earn an interest rate payment on a quarterly basis. That's a different opportunity. He manages our management company, PCG Property Management, oversees our current portfolio, and manages general business operations. I'm more on the marketing and branding, client relations. We send out monthly updates, quarterly financials. Our investors have a investor portal they can log into. They can access all this information in live time. It's similar to like having a stock portfolio account, but with Vanguard or something like that. But instead of logging on and seeing stocks, you log on and see your real estate. So the monthly updates, the quarterly financials are all emailed to you. The annual K1 tax returns are done for you, uploaded to your account, and everything's completely passive here as well. We have a podcast with over 170 podcast episodes. And here's our team, Lena Delgado. She manages our management company. There's a number of employees under her. Dana Sargenti does our bookkeeping. She makes sure our investors get paid on time. The ACH deposits go out on time. The financials are prepared on time on a quarterly basis, and the tax returns are done The K1s go out before March 15th as well. And Robert Grulich is a big part of that as well, our CPA, with tax planning, tax strategy, and preparing the tax returns for investors. So it's 100% passive investment opportunity for them. Here's some more past and current performance, our transactions through the years. I could send this deck to anyone who's seriously considering this investment opportunity. Here's some testimonials from our current investors here. We have over 100 investors. Most of them invest with us multiple times. Here's Robert, 8-time investor, Rita, 3-time investor, Frank, 4-time investor, Chris, 6-time investor, Tim, 6-time investor, Gary, 7-time investor. So our goal is to underpromise and overdeliver. Make sure that if you trust us with your hard-earned capital, we're going to do exactly what we say we do and make strong returns for you consistently through high-demand real estate here in North Jersey. If you want to learn more, here's a link to schedule a call with me. You can also, I'm sure King can put in the show notes, my Calendly link to schedule a call with me, Aaron Fragnito. I'd like to connect with you, learn more about your investment goals, see if they align with what we do here at People's Capital Group. And if they do, we can send you more information on what we do here to help people build and preserve their wealth through North Jersey real estate. So let's make it happen. Let's build our wealth together. I'm looking forward to connecting with the people in your network, King. That'd be a great opportunity.
Excellent. A couple of quick questions. You mentioned a portal, an investor portal. Where would they go to get access to that?
Sure. I can give you the link to that. They can go to our website, peoplescapitalgroup.com. And at the top, you'll see a link to log into our investor portal. That's one way to do it. I can also send you a link, and you can put it in the show notes for investors to go directly to this opportunity. But if they go to peoplescapitalgroup.com, you'll see on the top of the page, there's a link that you can click to access this investment opportunity. That'll bring you right to our portal there.
Excellent. Well, one last thing we want to do before we wrap up, I actually do want to put your calendar link here in the show notes so that folks can actually get access to that.
Sure. Do you have it, or you want me to give it to you here? Here, I'll want to put it here?
I'm showing on the screen, but we'll actually put that in the show description too, so someone can click on it and take you there.
Excellent. All right, friend, I appreciate you having me on here. I actually have to go. I have a meeting with an investor right now, and so I'm glad to be able to jump on your podcast here, though, and present what we do and connect with your guests. Do you have any final questions for me?
I do not, sir. I appreciate your time, and thank you, and I'll definitely follow up with you with the investors I speak with regarding this deal. Thank you.
Excellent. All right, my friend. Have a good day. Talk soon.
You too. Bye.